The following segment is sponsored by Green Platinum, trading in the U.S. as WGPLF and on the TSX as WG. Located in the Yukon Territory, Canada, the Green project has the potential to become one of the world's largest and lowest-cost open-pit producers of platinum group metals and nickel. Find them on the web at wellgreenplatinum.com.
David Morgan is an expert on silver, gold, and precious metals investments. He's a world-renowned lecturer appearing on CNBC and the Fox Business Channel. He's an author, having penned Get the Skinny on Silver Investing. And Mr. Morgan is a regular contributor and friend of the Ellis Martin Report.
David, welcome back to the program.
It's good to be back, Ellis.
Now, I'm going to Europe in a couple of weeks, and I just went over to the bank and ordered some euros, and I got that money today, and it looks like monopoly money. It looks like play money. There was a time I remember in 2001, 2002 where people were really pitching, involved in Forex and money markets, were really pitching investing in the euro. And I think at that time, if you did invest, even today, you've done well if you've held on to your euros. But what I really want to ask you, while the dollar is really strong and the euro hasn't completely tanked, the difference between investing in paper money and physical silver and gold at this point, how are we going to win? I mean, if you're a latecomer in investing in silver and gold and the physical metal, then you're probably not that happy. But if you got in about 10 years ago, you're still looking good. Let's say I've got some money, cash money, some paper, and I want to invest it. Where am I going to put it? Your thoughts, David?
Well, give you a long answer as usual. First of all, I think, for the record, I've actually made more money in the paper markets than I have in the physical market, which means that, starting when I did, if you got in on, let's say, Silver Standard that we recommended at 65 cents Canadian, and I forget where it went, somewhere up to 30 or 40. I remember getting out around the $22 level because I did a video update for our members. And this was before Robert Quartermain left Silver Standard, but the chart was very clear. It was breaking through support. I said, this is major, major support. When a company, a stock, a commodity breaks a major support level, you absolutely must, sell it. So we did. That would be like a 30 bagger or something. And we had several of those. What I did and taught, and some people did or didn't do it, was when we got these huge paper gains in the paper game, many times I converted that to physical metal. So in other words, silver might have gone from, let's say, the $5 level to the $14 level or something, or maybe at 300%. But some of these stocks were up 10-fold, 20-fold, that type of thing. And so we would cash out, and then I personally and recommended at times to go into the physical market. So the leverage in the mining shares is extreme at times, both directions. When you're in a bull market, you can expect something like 2-3 times as much gain as you get in the physical market, but the same holds true on the downside. So I'd be remiss to say it's a one-way street. Certainly it is not. But I think it's important to realize that I've always taken the market on a balanced approach, which means that you should start in the physical realm. If you're a metals investor, you should own metals because that is devoid of any counterparty risk. And then if you're so inclined or have the ability or opportunity or wish to take on different risk to reward profile, then you can move into mining equities. I mean, if you put me in a court of law, sat me down, took the oath to swear the whole truth, where is the most value? I would absolutely have to say the most value is actually in the mining sector. But that wouldn't be my recommendation because you have a counterparty risk. And no one knows how much lower this market's going to go. I doubt it's going much lower. In fact, I think perhaps silver did double bottom at the low 14 levels, but time will tell. We don't have enough data to know that yet. So again, talking out of both sides of my mouth, but very sincerely so, that one, it depends on the individual. If you're very risk adverse, buy metal only. If you're willing to take the risk, you should seriously consider the mining shares and do it intelligently. Look at the top tier, the mid tier, and the speculations. Certainly for our members only, we have several special reports. One of them is called Archie's Rule, and it gives you a good opportunity to evaluate a company, whether it's worth investing in or not. It's an objective take on what the cash flow of a company is, what their margins are, and whether or not it makes sense to invest or not. And speculations are just that, speculations. So these are situations where you bet a little to win a lot. And this is what the main focus of the newsletter business is. And unfortunately, it's not our main focus, although we spend a lot of time there. It's certainly an area that produces extremes. You can get some extreme winners and some extreme losers. And unless you know the timing of the market or the cycle of the market, when that part of the mining sector is appropriate to invest in or not, you certainly can reap some great rewards or really, really do yourself in. I mean, I have plenty of people that I've consulted with over the last several years that are pretty disheartened. And not to say that the whole sector, the whole commodity sector is off. It is. But if you look at our top tiers, I think every one except one is still at a profit zone from where we recommended it. That is not true in the mid-tier and the lower-tier stocks because they have been decimated and so many have gone out of business.
It's interesting. You mentioned Silver Standard, and I can't get many broker friends of mine to show up for these luncheons that they have in Los Angeles regarding penny stock mining companies, some of the juniors. Few people want to participate in that. They got burned, but conversely, I think the smartest brokers here in Los Angeles and perhaps, other parts of the country, they're investing right now in some of the top and mid-tier companies, and Silver Standard came up in conversation last week, and I remember a broker just saying, you know what, they're in. They're getting back in, and I guess you could say that the smart people are buying on these dips, right?
Absolutely. And most people don't understand about the stock market is you want to buy the absolute best of the best. I mean, buying a junior mining company might produce some spectacular gains. It's like buying a lottery ticket. I mean, most of those companies, it's exactly what it is because you don't know what you're buying. You're looking at something that might take place in the future, and the odds are like 1 in 4,000 against you. Treated it for what it really is. Whereas if you're looking at a top tier producer or near producer, the top tier would be a producer, obviously. You're looking at, okay, they mine silver. All right, what are their margins? Because any other company that mines silver, you're looking for the best silver producer out there. You're looking for the company that makes the most profit. Now, having said that, I don't have time to go into all of the math. It's pretty simple to understand. If you read my first book, Get the Skinny on Silver Investing, I take a whole chapter to explain why if you buy like an out-of-the-money option, which means a mining company that is not making a profit at today's silver price, for example, is highly leveraged to the upside when that silver price goes higher. I don't want to talk out of both sides of my mouth. It's pretty easy to understand. If you're really interested in that, get the book or borrow it from somebody. I think the used ones on Amazon are next to nothing. You can probably get the book for a couple bucks. It's well worth the read for just that portion alone that explains why you get more leverage. But back to your point, the smart money is moving back into the sector, but they're doing it as they always do, very slowly, very carefully, so as not to disrupt the market. These people know how to build positions, so they're not going to come in to a company like Silver Standard and put in, massive amounts of money in one day and drive the stock high, only to see it fall back. They will nibble at it, and nibbling for them is substantial shares for a retail investor, but they will do that until they have accumulated what they want. After the accumulation phase comes the markup phase, and then after the markup phase comes the distribution phase. And these are all clearly outlined in the charts. Even though some people say technical analysis doesn't work, it's not a perfect science, but certainly if you know what you're looking at, especially when you combine it with volume indicators, you'll get a clear indication of what's really going on in the markets. And it doesn't apply just to Silver Standard. This is across all markets. So this is something that, I like to do. I like to teach. I show it on my video updates when I do it for my members of the website. Something that pay attention to certain things, worth giving that attention because certainly you can do better. You can be a better investor, a more skilled investor, or, know when to be patient, know when to just wait it out and be patient. Certainly, to be self-criticizing. I've been patient for this 4 years. I mean, I'm really getting tired of the price action in the metals after 4 years. I certainly think that the fundamentals spell that there should be, much more activity in the metals and much higher prices in the metals than we're currently seeing.
You're very well known in the space, and people tend to listen and sometimes act on the things that you say. I believe you just said, use the word may, which is a cautionary word, may and probably and potentially. And it's always great to use those words. But instead of using that language, why wouldn't you say should you should invest in that. Wouldn't you think that your words, don't you think that the people like yourself can actually help move a market with pure logic? Because all the logic that you've stated is pretty sound. And why wouldn't you invest in the physical metal when paper is fragile and eventually it will crumble?
Well, great question. I mean, basically it gets to pretty much my philosophy, and that would be should means would beg the question why, and why gets into intent, and intent is, well, as he said in his own book, well, I think it's pretty obvious I am. I mean, we are probably one of the top services out there as far as analyzing mining companies and resource companies. It's not just silver companies or gold companies. We've done oil companies and, across the board, the commodities. So the intent is what is the other person's intent. Now is why I would say could or would rather than it should. But as far as, if I had the ability to present it in a fashion where they had to take a test at the end of the lecture, I got to grade it and I saw that they understood the concepts, then I'd certainly say should, because at that point they would know for themselves, not me telling them, but they would have learned the concepts for themselves. They would know to their innermost self that this is a paradigm that cannot last much longer, and therefore it's beholden to them to take the appropriate action, which would mean they'd have to escape the matrix, which goes further down the rabbit hole, which means they'd have to own physical metal. And that's something, but in a context of an audio interview, it's pretty hard to do that. But conceptually, you bet they should. But to say what is the intent has to come from them, not from me. I just am a big believer in that, Ellis.
Well, as long as you're not saying you should invest in a particular ABC company and list the name. Should is a word that you can use. I don't mind David Morgan using that word. I wouldn't want me to do it. I'm no expert. I'm just a journalist. And let me move into another point related to this. I watched your video that you just released a couple of days ago through investorpitch.com, and the headline is the 10 largest global markets are all crashing. And that's a big headline right there, and we may talk about that. But more importantly, for the purpose of this conversation is, you mentioned platinum and palladium, and you mentioned why platinum's price corrected. Let's use that word. And then you mentioned why palladium has moved up. Do you think the reasons for the decline in platinum and the uptick in palladium are sustainable? And if they are sustainable with regard to palladium, would you be looking for palladium investments even in the junior space?
Well, yes. I'm going to turn back the clock a little bit, because we were actually big proponents of palladium back, and I'm going to have to go from memory so my website members can criticize me on the blog, but I think it was around this level. I think it was around $700 level, maybe below. Might have been 600. And we got very enthusiastic about palladium and watched it go from that level all the way up to 900. And I did a video again for our website members about this is a pretty good place to be. There aren't many opportunities to invest in palladium in the stock exchanges, although Stillwater Mining is probably worth a look. It was structured in pretty tight share structure going back a decade ago. But since the Russians moved in, and I'm not saying anything negative about the Russians, they saw an opportunity. The company is not as tightly structured as it once was, but there aren't many palladium. I mean, North American palladium, I think they're out of business. I think they may be moving into the, my little jokey story about the miners go to pot. They may be going that route. I'm not sure. I'm just throwing it out more or less as a metaphor. But if you want to get in the palladium market, you don't have a lot of opportunity. There's some ETFs, and there's the physical metal, and there's still water mining, and that's about it. As far as platinum is concerned, you have some of the South Africans, and they're really not making any money at these levels. Anglo-American is having very big problems, just like Glencore. So there aren't a lot of opportunities. If I were to ask, what should you do if you wanted to do palladium, I would say it'd be smartest to get the actual metal itself. As far as will it be sustainable or not, I would say not until we get a good lift off in the gold market. Gold's pretty much the leader across the board, although the white metals sometimes give indications and give the subtle clues and start leading before gold really gets moving strongly. But between the two metals, the reason you have platinum going down and palladium going up is that platinum is used in catalytic converters on diesel engines, and palladium is used in catalytic converters on gasoline engines. And the idea now with this unfolding of what's going on with Volkswagen on their environmental problems with the diesel engines is thinking out into the future that there'll be less demand for diesel, more demand for gasoline, and that means there'll be more demand for palladium and less demand for platinum, and that's why you see the discrepancy.
Unless, of course, you're Cummins diesel, and I believe their stock was up the other day. The need for those engines isn't going to go away anytime soon, is it?
No, I mean, just kind of maybe a moot point, but I'll voice it. I mean, I drive a Volkswagen diesel. I own a Volkswagen diesel. In fact, and I'm not, people think of me whatever they want. I'm trying to maintain myself. I mean, I try not just to be me. But, I bought that car gladly, not particularly because it had such low emissions. I thought that was a great benefit. I believed the company when I bought it, but I bought it for longevity and great gas mileage and something that I thought was engineered rather well. I mean, it's a very quiet car, and I've never seen black smoke come out the back, but nonetheless, it's very disheartening that, we see this. But as far as going down that rabbit hole a little bit further, a diesel engine, being an engineer and having to go through, not only the mechanical side, but on the aeronautical, that's a very efficient engine, and they're very useful in certain applications. And unfortunately, Volkswagen has gotten much more than a black eye. This has certainly been a setback for the industry at large. But as far as just taking that subset of a diesel engine out by itself, certainly they're very, very useful. And the problems that have unfolded certainly can be solved, but it will not be something that's overnight. That's for certain.
The headline, 10 largest global markets are all crashing. You have no problem using the word crash.
No, I do. Absolutely. It's so funny because Investment Pitch has asked me to do these money and metals updates every week, and I get to them when I can. Almost every week I'm able to do one, and they put the headlines on there. Oh, okay. I gave the facts. I mean, basically crashing, I said it in the last Morgan Report, which is kind of interesting because if you're a paid member, you get a little bit different take on David Morgan than you'll get from these radio interviews. Not that I'm not trying to be consistent all the time. It's just that I don't have a lot of control of what headlines are posted because I submit my work, and then the people that have the work can, they can put headlines on there that I don't necessarily think are appropriate. What I gave were the facts of the 10 of the biggest stock markets in the world. But what I said in the Morgan Report a month earlier is that to really get a quote-unquote crash, you have to see 20% down in a market. Now, some of those markets have crashed. I mean, just do the math, and I say it in that update. But for the U.S. markets, as an example, they have not crashed yet. Although I've had people on the radio say, well, use the word crash. And I did. And I said by the end of October. But we'll see. I could be wrong on that. So far, I am wrong because we'll see, 10% or something. So, yes, some have crashed, some have not. Certainly, Chinese market. I mean, I'd rather focus more on my expertise to come back to Glencore. I mean, that company, which trades, I think it's 80 or 90 commodities, is off like 77% for the year. That's a crash. And that's one of the stalwarts in the whole commodities complex. And that's very worrisome for anybody that's involved because the derivatives exposure that company has. And they have derivatives exposure to big major mining houses. So this is something that could be somewhat similar to the Lehman Brothers AIG situation, where AIG is sort of the big boy on the block, so to speak, that had to get bailed out so the derivatives didn't fail. And I'm not saying that's the exact analogy, but it's pretty close because this is a huge concern, concern in both ways. It's a big, huge conglomerate, and it's very concerning how many ties go out, how many tentacles go out into the commodity complex and what the repercussions will be. And we don't know that yet.
And yet we made it through another September, this particular September, without a black swan event that so many people were possibly pointing to. Do you see anything? I hesitate to even ask this, but how are you feeling about October?
Well, I think it was good that you brought up the September thing. I was trying to be objective about it and trying to keep not too hypey about it. I mean, I've seen this stuff for so long. I mean, I could name so many, but you just go back to the Y2K incident. So many people thought there would be, some kind of major repercussion with the computers not recognized in the year 2000. I mean, that came and went. And one silver comment on that was a huge premium on junk silver bags at the time because a lot of people thought there would be a problem and they owned, junk bags, which is known pretty much as being probably the best silver you could own on a barter situation. And of course, once the Y2K rollover took place and nothing happened, the premiums came out of that market quite substantially. As far as October, I still think the market's overvalued from several metrics. I think that the pros have been getting out of this market for a long time. And I think that we could see another 10% down in the market, which if you add to the 10% we've already seen, would put it around 20%, which would be, more than a correction. It would be moving toward the bear market territory. I don't rule it out. I don't know. I think it could happen. I certainly did open my mouth back in, I think, March on the Greg Hunter interview and said I thought that by the end of October, it would be evident that there would be a stock market correction. I might have used crash, significant enough to change the paradigm going from the equity market back into the commodity sector. But, we have a month less. Time is getting short. I'll probably get some more negative commentary on my interviews, and that's okay. Just do the best I can. Greg asked me why, and I don't even know if we talked to Shamit on that first interview. I think we did in the second. But my main case was cycle theory and stock markets. Usually the September-October timeframe is the most negative for the equity markets. And that is what I based it on, and the 7 years. It's usually a pretty clear 7-year cycle in the stock market. So it was based on that more than any of this other stuff that other people have come up with. And I'm not discounting anybody's ideas or opinions. I'm just saying that, that's mine. Stick it to it. We'll see what happens. And nobody really benefits from a bad bear market. All I'm trying to state for the record is that the metrics of the valuations of the overall market is very overvalued relative to the physical economy. There's a real mismatch between what the financial markets show you on TV and what the physical economy is actually doing.
David, it's interesting because I learned that you were on a podcast that's sort of mainstream but alternative media. In other words, it's not mainstream media, but it's a well-known host. His name is John B. Wells. Do you find that you're doing more interviews? In other words, are you talking to more than gold bugs and silver bugs right now? And why do you think that is?
Yeah, it's interesting. Yes is the answer. I have certainly broadened the base as far as the type of interviews I've received over the last 6 months or so. I think it has to do with people that have listened and look at my knowledge base being more than just, the precious metals and just the silver market. And it's interesting on that 3-hour interview with John B. Wells that we actually got into a lot of philosophy. Now, he had the book and had read the book before he did the interview. He read the Silver Manifesto, and he had several parts of the book that he had highlighted. In fact, he read quotes from the book as part of the interview process. So that made it a very lively interview. Started going down one of these trails about the philosophy of, freedom, liberty, what's required of the people, we the people. And we're down that trail for about 20 minutes or so. And I kind of pardoned myself, said, well, this isn't really on the topic of, he said, I want to continue. This is talk radio, and I really want to explore this more. You're giving some very interesting insights into what you believe. So we went down that further and further. So I think it has something to do with, one, I think the gold silver story is so well known in the group of gold and silver people, but there are tangential items that go along with gold and silver. I mean, to me, my thinking always goes from the top-down analyst, meaning, look at the macro picture, which is the global economy. And then from the global economy, look to the financial markets. From the financial markets, look into the debt markets and the equity markets. And then from the debt and equity markets, look into the commodities exchanges. And then you drill down, you get to, well, why would you focus on gold and silver? And as I've always said, well, they're different commodities because they're commodities in quotation marks. They're real money that circumvents counterparty risk. And for that reason, they're the top tier of all commodities because they're money. So that's sort of how I think. And I guess here and there, once in a while, someone comes along and says, geez, that's a pretty good topic. I'd like to interview them for this show on a topic that, let's say, is not directly related. It may be related to gold and silver, but it's certainly at a higher level, let's say, than the gold and silver markets.
Kind of the prepper space, too, a little bit, don't you think?
Yeah, it's true. I've actually been interviewed on a couple times. I just did a live presentation in Kalispell, Montana a couple weeks ago. And it was certainly what I do, which was focusing top down into the metals, but a lot of those people had questions on basic preparations. And, I've certainly would consider myself to be prepared. I mean, it's only, having had a small stint in the Boy Scouts, be prepared. I mean, that's one of the mottos.
Are you seeing some of these folks more of a broad-based subscriber base other than just your typical gold and silver bugs?
No, it hasn't really spilled over into the website membership. I think the name silverinvestor.com has a lot to do with it, and I'm going to rebrand to the Morgan Report. We're building the site now, and it's so cumbersome because there's so much there. We wouldn't take the Silver Investor website down. We'll leave it there for the public. I mean, there's so much time, effort, and money into that site. It'd be stupid to take it off. But we're just going to make a much simpler, more direct site called the Morgan Report, so people that have memberships can just enter into that portal and read what we do best for our paid people. And it'll be just something that just rebranding. If you want information on the metals, you can go to this one website. If you really want the Morgan Report, which is about investing in these markets appropriately, that will be what we'll be talking about. So it's going to be, I hate to give a date because, it's out of my control somewhat because, our staff has to do the hard work of moving all of these links over into the new website, but it probably will happen by the end of the year or early next year.
And really, it's pretty easy to find you. Just type in your name in the search engine, and a lot of things come up. You're the most well-known David Morgan there is.
Yeah. Well, I'm not sure about that. I've tried that myself in the past. Another one, clothing manufacturers, something that came up first. But whatever, it doesn't bother me one or the other.
You are a sharp dresser. I'll give you that.
Yeah, thanks.
David, it's always a pleasure to speak with you. Thanks for joining me today on the program.
My pleasure. Thank you.
I've been speaking with the silver guru, David Morgan. His website is TheMorganReport.com. Listen to the segment again on the homepage of our website, EllisMartinReport.com, or download the entire Ellis Martin Report on iTunes. The preceding segment is sponsored by Wellgreen Platinum, trading in the U.S. as WGPLF and on the TSX as WG. Located in the Yukon Territory, Canada, the Wellgreen project has the potential to become one of the world's largest and lowest-cost open-pit producers of platinum group metals and nickel. Find them on the web at wellgreenplatinum.com.